welcome to the program. I'm Marty Shenkman, joined by my friend and colleague, Jonathan Blattmachr. And this is sort of a potpourri discussion of various topics, all relevant to planning in the current environment, with some current developments, some planning ideas, and hopefully enough new ideas or thoughts or things that will keep you all interested. As we get started, I'm going to have a quick acknowledgement from some of our sponsors, a couple of pointers. The PowerPoint will be on the Peak and ILS website. We're transitioning all of our content from my various websites to a new website that was just launched. If you have some issues with it, forgive me, but we're getting the kinks out of it. It's brand new, Shenkman Education. And we're putting all our web content there to make access to educational materials easier. We don't give CPE or CLE, but you will get a certificate from, actually, we won't give a certificate because, oh yeah, we'll give you a certificate, but it comes directly from the GoToWebinar platform. And if something doesn't come through to you, there's nothing we can do. Forgive me for that. So, Teresa, tell everybody who Interactive Legal is.
Absolutely, I'm happy to. We are pleased to sponsor today's presentation. We sponsor a lot of these with Peak and with Jonathan and Marty and others speaking. Interactive Legal is an automated document assembly system and provider of estate planning and elder law education. Jonathan, of course, is the founder of Interactive Legal and he's the editor-in-chief. Marty is one of our advisors, as is Abby, who's going to speak in a moment. And we update our documents as often as we can if there are changes in the law, state or federal. So when you're putting an estate plan together, you're working with the most recent information. And we have a brain trust of authors and advisors behind the language in our documents so that it's always reviewed and always up to date. If you're interested in learning more, you can go to interactivelegal.com and you can view upcoming webinars, including this one will be there. After you all watch it, we'll get it posted there as well. You would have to create an account to view other webinars, but that way you can view all of our complimentary content. And you also can schedule a time to take a guided tour of our system, which we would be glad to show you. Thanks again, Marty. I wanted to say that this is a potpourri and so many of the issues that you're going to talk about, we have something going on in our documents or our education that addresses it. So we're happy to help with more.
By the way, that's the real power of document generation software generally. If your firm is drafting the old style way using standard firm forms, you really need to look at document generation. The myriad of different decisions and options that can be done in a document generation program to tailor planning to a client's needs is really just dramatically better than the old style way. And if you're still doing the old style way, you really need to look into this. And Abby, who is Peak Trust? My trustee, I know who you are, but you'll tell everyone else.
Thank you, Marty. My name is Abigail O'Connor. I'm the Chief Fiduciary Officer at Peak Trust Company, and we are honored to sponsor Marty and Jonathan's presentation today. Peak Trust is a corporate fiduciary in Alaska and Nevada. Our philosophy is simple. We offer options and flexibility, and we are easy to use. Peak serves as trustee of directed trusts, bifurcated trusts, delegated trusts, and we also serve as full trustee. I'm guessing many of the concepts that you hear about today from Marty and Jonathan in trust form are trusts that we can manage. So we serve as trustee for families all over the country. Very few of our grantors are actually in Nevada or Alaska. Marty and Jonathan, thank you very much for doing this presentation.
Abby, if I come to Alaska to visit my my trust in Alaska, can I write off that business trip?
I'm not providing you with legal advice, but I can tell you we can go fishing, Marty.
All right, thanks. She didn't say, by the way, that she's going to guarantee that I catch something good.
Well, we call it fishing, not catching.
I've mentioned Shenkman Education. we welcome any feedback, and hopefully it'll be an easier user experience, and forgive the typical issues that arise when anyone launches a new website. Ignore the time frame here because we were going to do 90 minutes. We're going to try to, if Jonathan remains shy, we may only do 60 minutes. So don't mind the times. But some of the topics we're going to talk about: non-grantor trusts. There's been a lot of talk about it. What I'm going to ask Jonathan to comment on, and I've prepared slides on, is talking about this issue of an adverse party, because one of the most common applications of a non-grantor trust is having a spouse as a beneficiary to permit access, which is critical for a lot of clients. And you can get a lot of interesting income tax benefits. We've covered that in depth in other courses, which are on all three of the websites mentioned. But what is an adverse party and how does it really work? There's been a lot of talk. I've been getting a number of inquiries from colleagues and a lot from financial advisors. Should we terminate? Can we terminate this irrevocable trust and get the assets back in somebody's estate for a basis step up? There's no estate tax benefit from terminating the trust. If you haven't gotten a whole boatload of questions from clients and colleagues and advisors about that, you will. So we're going to talk about that. The Delaware asset protection case, we've done an entire program on. There's a new development that I don't think changes the positive results, but shows how limited they are of the Delaware case. We're going to talk about that because it's a really important lesson for practitioners. We're going to talk a bit about access, because I think for most clients, if they're well beyond the exemption amounts, they should be planning with all the techniques and all the reasons that we've always known. But clients that are under double the exemption amount, under somewhere in that ballpark, whether it's 20 million, 40 million, 50 million, many of them are uncomfortable planning. And I think the calculus, the analysis of how much access versus how much security that it's not going to be in the estate is now different. And we're going to talk a little bit about that. Jonathan's excited because he loves to talk about SPATs at any opportunity, but that's certainly one of the things to think about. We're going to make very quickly a few comments at the end about planning for moderate wealth clients, because there's no reason that the kind of planning techniques that we use cannot be practically and cost effectively adapted for people with much lower wealth. Many of you probably serve clients with $2 to $5 million or $2 to $10 million of wealth. That's only become a moderate wealth in light of the very, very high exemptions, relative to the net worth of the average American, or even, the top 10% of Americans. 5 or 10 million is still a lot. So we're going to talk briefly about that. And portability, I think everyone knows what portability is, but we're going to just talk about a recent case and remind everyone how important it is to remind clients to deal with portability in the current environment. So Jonathan, I don't think we need to give too much background on non-grantor trust. We've done programs on that. I think, the idea of using a non-grantor trust to get extra charitable contribution deductions if the standard deduction is preventing you from getting or limiting you from getting a full deduction, the ability to expand 199A deductions, possibly expand SALT deductions with the new additional $30,000. Let's assume everyone knows that. But one of the things that, unless you want to mention something else, one of the things that I think is very important and needs to be talked about is a common structure for many clients that are married is to use some type of spousal lifetime access trust. And especially if somebody is below the exemption amount and wants to have a non-grantor trust to maximize income tax benefits, the question becomes, how can you get access? The best way to get access is to have a spouse as a beneficiary. But if a spouse is a beneficiary, that automatically taints the trust as a grantor trust and you lose the income tax planning. But if the spouse can only get a benefit if that distribution is approved by an adverse party, we can have the non-grantor trust that is being sought after. So I don't think enough people understand some of the nuances of what's in a non-grant, what is it takes to be an adverse party, and some of the case law on it. Before we get to that in more detail, do you want to mention anything about multiple trusts and 643F?
Well, Section 643F, which has been around since 1986, but only recently had regulations which made it a live issue, basically says that if you have more than one trust and they've been created by the same person and husbands and wives are treated as one for this purpose, and you have basically the same beneficiaries, and if saving income tax was a motivation in creating the trust, then they're going to be created as one trust. So the ability to get bracket right, to get additional exemptions and additional benefits is gone for that. So that's basically what Section 643F says. And again, if you are married or you have kids, that's tough. But it is true that if you have 3 kids and you create one trust for each child, they will probably be considered separate and independent trusts. And so you'll have 3 trusts rather than one, which means you can do some special things that you can't do if you only had one trust.
Do you think there's any help of adding, like an elderly parent or aunt as a discretionary beneficiary in, say, one of the trusts, but not another? In other words, add in some more beneficiaries?
I think that helps, Marty, but the primary thing is to put in that, my oldest child is the primary beneficiary of trust number 1. My second child is the primary beneficiary of trust number 2, and so on. You could add nieces and nephews, but you need to make them sufficiently different so that just looking at them, they appear to be separate trusts. But keep in mind that the tax law has basically been developed so that you can put in what you want, but if in fact if you operate them as basically one trust, you're probably going to be very disappointed if the IRS comes in and audits you.
Important to keep in mind because there's been a lot of discussion and there can be a lot of value to having multiple trusts. Do you want to comment quickly on conversion? Because that's something that people are asking about. It's not so easy to make a grantor trust non-grantor.
Yeah, it's not so easy, and you can have income tax effects, as the last item on this page shows. You sometimes can trigger gain if you go from a grantor to non-grantor trust status, which you may want to do. You may have gain, and that first came about in Revenue Ruling 77-402, where going from a grantor trust to a non-grantor trust was treated as an income tax event. And you don't want that to happen, or at least you've got to be prepared for that. So keep that in mind, please. The other thing that you want to think about is that even though you look at the trust and you say, well, clearly this trust has an adverse party because this is a trust I've done for my wife, and she can only receive a distribution with the consent of my child, and he's the presumptive remainder beneficiary of that trust. Boy, that sure looks like that child is an adverse party. But when you get into the case law, the courts have said, look, not so fast. You can put that in, but believe me, if we see that you've just gone along with what the grantor wanted, we're not going to say that that person really was adverse. So don't think just because you put in someone as a discretionary beneficiary at the end that you're going to be okay. Even if you make them the beneficiary by default in the event that your spouse dies and your spouse is going to take it, you might say, well, look, it's, when you take a look at the definition of adverse party in section 672 of the Internal Revenue Code, clearly that child is an adverse party because that child would be hurt if someone, took property in that trust and gave it to that child. But that's not what the case law says. So you've got to be very, very aware that merely thinking, oh, look, I've got it made, I put in the right terms. No, don't. Make sure at a minimum you put in that notwithstanding any other thing out there, you cannot make a distribution without the consent of an adverse party, meaning someone who is adverse within the meaning of section 672 of the Internal Revenue Code. Please do that no matter what you put in. You put in the child, you put in the grandchild, you put in your brother, you put in your sister, but make sure you put in that notwithstanding anything else, you have to have the consent of an adverse party.
Jonathan, let's talk about it for another minute because I think this is really important. And I don't think it's given enough attention. Let's say I name my oldest son as the adverse party to approve a distribution to my wife. And we set up these trusts, and every year for the next 15 years, 20 years, he approves distributions. Doesn't that look like an implied agreement?
Well, Marty, I don't think it matters whether it's implied or not. It's just they're going to say, look, Marty is so wealthy and he controls everything in the family that even though on the face of it, it's that way, and even if you haven't always gotten his consent when you've made a distribution to the spouse, we're going to find that he really is not an adverse party. And that's something that, as a practical matter, you can really think about hard. So you've got to put in those magic words and make sure you administer the trust accordingly. Have some circumstances where the spouse asked for something and the child refused to do it, and it should be substantial. And even
And
there,
document it.
you can't have a guarantee.
Yeah, I think that's very important. If you have a clear pattern, it suggests that the child may not be independent enough because of other family wealth to really be making a decision about approving a distribution. And I think the idea of having distributions non-consistent, more sporadic, have a distribution refused by the child for reason, I think makes some sense. And the other thing, and I don't know that I actually can remember one client that actually called me where they had a non-grantor spousal lifetime access trust, and they wanted to make a distribution for a particular reason. And they actually called, so I had the child that approved it document in a signed writing sent to the trustee that they approved the distribution. I don't know that people really take the effort to document this. I think they kind of just view it as, well, yeah, it's okay. The kid approved it and move on. I think you want to take the time to formally document it. Otherwise, how can you demonstrate that it's been approved? And if you have an institutional trustee, they're probably more likely to ask for some type of corroboration of the approval. If you have a family trustee, they may not ask for anything. But I think it's important for practitioners to caution clients that when they're creating such a trust, it's not without risk that the IRS may argue that the adverse party may not be adverse in that context of that particular family. Jonathan, so let's say somebody sets up a trust and the kid has to approve, the children have to approve distributions to mom. What if the children are minors? How would you deal with that?
Well, Marty, the law isn't very clear. Normally, if you have the words in there, that's sufficient because even though you don't have a guardian, that's sufficient. But keep in mind that if you have minors and someone says, well, you really should have a guardian, would the guardian really approve it? I mean, there's very little case law on this, but some of the case law suggests that it's almost impossible to get a child who's a minor to approve of something which would be adverse with respect to the child. So I think you're better off not putting the child in there or to say it has to be approved by a guardian. But again, once you're in there with a guardian, you've got an entirely different kettle of fish. And you may find that the guardian might say, well, look, I'm not going to approve this. Why should I approve it? And again, there are some cases. There's a case, I think, out of Alabama many, many years ago, where under the circumstances, which were very peculiar, they said, yes, the child is adverse and that would be okay. But other than that, I think you're going to find that having a child in there who has to approve things, it's going to be almost impossible to get that child's or get the guardian for the child's approval.
I think a guardian is going to be in a very difficult position because the guardian is supposed to protect the minor. And why would the guardian give up money that the minor may need?
Correct.
That should be thought about. But again, as Jonathan's explanation shows, if you have the language in there, that's a great start. But you got to caution clients that it's not foolproof. And I think it's really important, which I know we all find a challenge, to get clients to call us before they do something like this, and to come back periodically for update meetings so the advisory team can review what they're doing to corroborate it, to make sure it's not too regular, creating a pattern. Jonathan, let me ask you one last question, and then we'll go on to our next topic. But I think this concept of adverse party needs more attention than some are giving it while they're focused on getting an extra 199A deduction. What happens if the practitioner puts in a trust? The oldest minor child shall be the adverse party. I'm sorry, the oldest child shall be an adverse party for purposes of approving distributions to the spouse once they become age of majority, because they can't really sign anything as a minor. While the minor is under the age of majority, the eldest living minor, I designate Aunt Jane to act on behalf of that minor. Thoughts?
Well, Marty, I mean, that's better than nothing because, again, as you stated and as I've stated, to have a guardian approve it is very, very tough to convince someone that that person who is approving it is truly independent and is doing what's in the child's best interest. Sure, you can put in that Aunt Jane has to approve it. I'm not sure it's going to work. I think if you really want to have it work, you need someone who's going to really have the best interest of the other people in mind. And that person can consider anything he or she wants, but that's very, very tough to do. Again, I think the best thing you can do is to put in the magic words from section 672 and hope that no one comes in and challenges it. That's the best thing you can do, but it ought to be used extremely sparingly, I think.
And for a lot of clients, especially as you go down the wealth and income ladder, we're trying to get these SALT and charitable deductions. They're going to need access down the road because they're not at the wealth levels doing this type of planning. They're trying to get an income tax benefit. Jonathan, and this is not a plug for ILS, but I think it's a great comprehensive tool. In the interactive legal software, they have a savings clause that basically, real simplistically, says, hey, whatever else we said anywhere else in this trust, notwithstanding any of that, this is a non-grantor trust. And then it lists all kinds of things that can't happen because they would taint the trust as grantor. I think the idea, whether you want this language, you want to use your own language, but I think the idea of a savings clause is really important. The other thing is, if you are converting a grantor trust into a non-grantor trust, you may want to consider integrating this kind of savings clause into the actions that you're using to make that conversion, so that in case there's some boilerplate somewhere hiding in the trust document that was missed, you're not going to unravel the income tax consequence you're trying. Jonathan, if I'm converting a trust, well, I guess first, do you want to make any comment about savings language?
Well, I think it's very important to have it, Marty, but you've got to respect it. Remember, there are cases, there's a case out there called Wiley, I think, which is
Yeah.
really not so much a tax case, but an SEC case, where even though the magic words seem to be there, the court just said, hey, they didn't respect this. We're not going to respect it. So, taxpayer, you lose. So you've got to be very careful. Just don't say, well, we have magic language in there. We have a savings clause where it should be perfectly okay. It should be, as I said, used extremely sparingly. And in fact, one of the things that you can do is to consider, not having a grantor trust.
If I recall the Wiley case correctly, the argument was that the settlor was controlling the trust protector, and therefore the trust was a grantor trust, so the income was taxed here so they could get a settlement out of them. But I think as you explained, the merely having the language isn't enough. You have to kind of walk the walk, just not talk the talk. And if you have a situation where it's apparent that the supposed adverse party is going to approve anything and everything, you may lose out. Final point, if you do convert a grantor trust into a non-grantor trust, consider incorporating the savings language. And the other thing you may want to do, I think it makes sense if you do the conversion, is to then have the trust decanted into a new trust that is drafted from inception to be a non-grantor trust. Too many of our trusts have been grantor trusts for ever so long, and so many of our trusts have language peppered throughout them that are really consistent with grantor trust status. You just want to be careful that if you do a conversion, you're not going to get tripped up by a provision you weren't looking at. Any final thoughts on non-grantor trust, Jonathan?
Well, I think, Marty, the bottom line is that very few practitioners are aware that no matter what language you have in there, the case law, and again, you have to go deep in it, and I've done that, to determine that the trust is not going to be or is going to be a grantor trust. Because even though you said, well, it's got to be distributed only with an adverse party, if you don't respect that in operation, you're going to lose.
We're gonna all the ILS savings language. ILS was gracious enough to let us use it and give it to you. I think it's a real great checklist of things you want to consider, and if you don't have savings language, you want to adapt something. Let's let's move on. We're gonna skip through this because we wanted to focus on adverse party issues because I don't think that's gotten enough attention. Jonathan, let's change gears and talk about this topic that I'm getting a lot of questions from people on, and I know people are going to make mistakes. I also know clients are going to just do this on their own without talking to their advisors and then come to us after they've created a disaster. So let me sort of set the table for you to explain this with an example. Dad died, funded a $2 million credit shelter trust when the exemption was $2 million for surviving wife. Wife is now the beneficiary of a credit shelter trust. And maybe the trust has grown to 3 million. But at that level of wealth, the family is nowhere near an estate tax issue with a $15 million permanent exemption. So what is the benefit they're getting? They get to file a tax return every year and pay an accountant to file the tax return. Unless they've incorporated flexible beneficiaries and are splitting gifts by distributing, D&I out to kids in lower brackets. And that's not always the case. There's really no income tax benefit. So for no income tax benefit and the ongoing administrative cost, they're getting zero estate tax benefit. And when mom dies, the 50% appreciation, and it may go up in the future, is all going to be carryover basis to the children as remainder beneficiaries. And that's a very common transaction. I'm not sure my statistic is right, but I think there's about 2 million credit shelter type trusts out there, testamentary credit shelter trusts. So then the question becomes, well, if I terminate the trust and put the money back into mom's name, the assets of the credit shelter trust, now when she passes, we'll get a basis step up. So why don't you take a couple of minutes and start talking about all the different issues of what might need to be looked at before you terminate or modify a trust?
Well, Marty, again, the stepped up basis is exceptionally important. In fact, there's really more focus on that than saving estate tax. Although if you're in some states where you have a very low estate tax exemption, that still could be important. And even though you may not have that right now, that could possibly come up at a later time. So you've got to be very careful about that. But, the question is, should I terminate this trust and give it to the spouse so that it will be in his or her estate when they die and we'll get a change of basis? Well, keep in mind a couple of things. Not all assets go up in value. Some may go down, and you'd want carryover basis there for those assets rather than having, have them included in the spouse's estate and therefore have a 1014A automatic change in basis when the spouse dies. So that's something you need to think about. More important, remember, a trust serves so many important purposes. And if you're giving up the benefit of the trust, asset protection, protection from a new spouse, protection from relatives, which can include the children who may really put pressure on the surviving spouse to give them the property, you may have a serious problem. And there are some things that you can do. One is, if you don't already have it in there, is to try to decant the trust to give the spouse a special power of appointment. And you might say, wait a minute, Jonathan, we're trying to get this in the wife's estate or the surviving spouse's estate. So we want it to be a general power of appointment. Well, under section 2041A3, this is very, very important. You can cause assets to be included in the estate of the person who has a special power of appointment by having the power exercised in a certain way in order to trigger what is known as the Delaware tax trap, which is section 2041A3. This is an old provision which goes back, almost 100 years now, where the Congress decided that even though you had a special power of appointment, we were going to cause the assets to basically be in the estate of the power holder if the power holder exercised the power in a certain way. You need to be aware of that. And by the way, that's something to build in, but got to make sure it'll work in your state. If you're in a state which has no rule against perpetuities, you may not be able to exercise that power in a way to trigger the Delaware tax trap. It's very important. And Jeff Pennell, Professor Pennell, and I first wrote about this in the April 1988 issue of the Journal of Taxation. So that's something that you really need to think about when you're doing that. Other thing is, if you have the Delaware tax trap, you can pick and choose which assets you want to be in the estate. If you terminate a credit shelter trust and give it all to the surviving spouse, all of those assets are going to be in the spouse's estate. And there are two actually terrible consequences. Now, the spouse now owns those assets and they can be swindled from him or her, or they can make foolish decisions. And in addition, some may go down in value, which means you've now made a mistake. You shot yourself in the foot because you didn't want them in the estate because you'd want carryover basis because they've gone down in value, at least under current law. So please keep that in mind. You almost never want to terminate a trust. There are other ways to get what you want without, basically throwing the baby out with the bathwater.
Jonathan, let me make a few comments to highlight some of the things you said. Slide 30 on the top talks about basis step up. And somewhere in the materials, we say exactly what Jonathan just said. Everybody talks about a basis step up on death. I wish I had a guarantee that every investment I ever made only went up in value. Jonathan, has that been your experience? Every investment you've ever made goes up in value?
Of course not, Marty. And indeed, even though we've had wild increases in the marketplace, especially if you've been in the Magnificent Seven like Intel, you really need to think about the fact that you may not want to have those assets includable in someone's estate for estate tax purposes to have an automatic basis change.
Because it may be a negative through a step down. It's not a basis step up. It's an adjustment to fair market value. And that's really critical. And most clients, all they hear about is basis step up because they read something online, or even better, which I'm seeing, and I know all of you are seeing all the time now, they're not asking us first, they're asking Copilot or ChatGPT what the answer is, and then they're coming to us and telling us what they want done without understanding the implications or the possible errors in what they're looking at. There's another issue, and Jonathan mentioned it broadly, but I want to mention it. I think it's called, and forgive me if I don't have the correct name because I've seen it by different names, something like romance fraud. There is an incredible amount of money swindled from elderly widows and widowers and just elderly and in general people based on romance scams. And I had that happen to a client decades ago, before it was nearly this bad, that his wife had died. He was distraught, and somebody in the community got a hold of him. Next thing you know, they were married. Never called me, never talked to a lawyer, didn't get a prenup, and within some kind of short period of time, they got divorced, and she went away with half the money. And the kids were really upset. Terminating a trust, as Jonathan said, you really got to think very hard about it. Does it really make sense to do? Are you assured that the money is going to remain safe? What about Medicare issues? And I think that's something, I don't do special needs planning, but you need to make sure that if you're terminating a trust, you're not exposing it to that issue. And irresponsibility, who's the trustee? If the spouse is a trustee, the surviving spouse, even subject to a HEMS, how do you know what they're going to do? What controls are there? So I think
Well, Marty, what you say is so true. I mean, almost every benefit you can get by taking assets out of a trust, you can get even if they're in the trust, not just the stepped up basis, but other things as well, including control. I mean, if the spouse says, look, I've got to have more control over these assets. My spouse didn't give me any control. You can probably decant the trust and give the spouse a lot of power over the control of the assets without upsetting what the family really wants. But you're right, Marty, especially as you get older, you're going to be prone to, I don't know if you want to call them scams or unfair influence, but it's not what the family really wanted.
Jonathan, one of the simple solutions to address some of this, to me, is why don't you first divide the trust, this irrevocable trust, put the most highly appreciated assets, and maybe not all of them, maybe some of them, into a separate trust from the others. And whatever action you're going to take, just take as to that, see how it works out, see if more is necessary. You don't have to take the action as to all the assets of the trust.
Well, that's true, Marty. And let me point out that sometimes people, as you say, it's not just romance scams. It's, children believe, well, I don't want to wait until mom dies. She could live to, 90, 100 years of age, and I need the money now. Make sure you have at least some independent person who has to approve enormous changes in the disposition of property. That really makes sense. And it doesn't matter whether the other spouse has died or where the assets are. You want that additional protection for the family. Also, keep in mind for practitioners that if you don't have that happen and something adverse occurs, you may wind up being charged that you should have really not been asleep at the switch. You were the attorney for the whole family and you should have watched out for what happened. So don't think that just because you say, well, I didn't do this, the trustee did it, it's not going to be enough. If things go bad, you're going to be sued along with anyone else.
That to me is probably the major issue. You have to be really careful. First of all, Jonathan said, mentioned you may be representing the whole family. Who are you representing? What does your retainer or engagement letter say? What is their perception? The children may very well feel that you're representing the entire family, as Jonathan said, and that's very common, but maybe you're only representing the trustee in this transaction. You need to be very cautious. And I think that one of the mistakes, and I'm sure we're all going to see the mess that's created by this, is the clients are going to hear on the golf course or do their own AI research, and we all know how questionable that can be, and just terminate the trust, put the money back in the elderly parent's estate. And the next thing you know, the stuff hits the fan and it's a problem. At minimum, I think what should be done is there should be some type of agreement explaining what's going on, the risks and the issues that's signed off by everybody, all the remainder beneficiaries. And you may want to consider, which clients are not going to want to do, if there's no virtual representation clause applicable to that trust before you terminate it, you may want a guardian for future born or minor beneficiaries. But you should have something signed off where people are acknowledging it, and that in that agreement, it makes very clear that everyone should get their own counsel, that the advisors to the trustee are not representing the beneficiaries, because their interests are adverse. Any other thoughts about trust termination, Jonathan, or how to go about it?
Just go ahead, Marty. We're falling behind, as you know.
So there's more detail here, but we wanted to bring this issue to everyone's attention and give you some thoughts on it. And there's more materials in the slides because this is going to be a very common thing. And I think the scenario I painted where a credit shelter type trust was created years ago because it would provide a huge tax benefit. Now it's providing negative tax results and nobody's really addressing it. And by the way, if you're an investment advisor investing assets from such a trust and you know they're appreciated, you look at the statement, you should bring this up because the clients, it may be completely not in their thought process. Accountants that are preparing income tax returns, Form 1041 for these trusts, bring up these issues. So Jonathan, let's change gears again. There was a recent Delaware case that upheld a self-settled trust, which is a good thing. Do you want to, we've talked about this, we've done a whole webinar on it, but do you want to just make a few comments and then we'll talk about a new development for that client, for that defendant?
Well, Marty, the question is, do I really have to worry about anything? If I want to be the beneficiary of my own trust, can I go ahead and do it safely? But, whether it's for your spouse or whether it's for a child, but it's something that you need to consider because you say, well, I don't want these assets subject to the claims of creditors. Keeping in mind that the more rights you give the beneficiary, the more of an opportunity there will be for the beneficiary's creditors to claim that the assets in that trust are subject to their claims, the claims of the beneficiary's creditors. So you've got to keep that in mind. And you want to make sure you protect it. I mean, there's more money lost to claims of creditors. And keep in mind that if you have someone who's been married, there's a 50% chance that his or her spouse is going to become the major creditor in their life. And that can be very upsetting. You love your son-in-law, your daughter-in-law, your grandson-in-law, whoever it is, but you find out that there is now a claim, and that person whom you have adored was a member of your family, now becomes the family's worst financial enemy.
The case in Delaware and the citations in the materials, it's an odd name like CES Trust 2007. The Delaware court upheld the validity of the trust because the trust met the various requirements of the Delaware Asset Protection Statute. Really important, and I think this is a critical message. The trust was created and funded, I think 7 years, maybe longer, before the actual claim was brought. And that was really important to the court. Clients need to act sooner than later. Once a client feels they need asset protection, it may already be imprudent or too late or not ideal in terms of timing to create an asset protection trust. It should be done far sooner. I think with the very high exemptions for clients below this amount, the only way to entice them to give assets away may be to assure their access to the assets, whether it's a DAPT, a SPAT, hybrid DAPT, but that needs to be considered as well. So these on slide 38 is the list of the things that were upheld. It's really important to note that even though the Delaware court said that the self-settled trust was valid under Delaware law, the client committed way too many foot faults, did a lot of things that were really, let's call them inadvisable or sloppy, transferring assets in and out of entities that were owned by the trust, et cetera, that it was worrisome whether or not the foot faults would have been too many and undermined or torpedoed the protection the trust gave. And that's kind of, in fact, what happened after this particular case was litigated in Delaware. The individual, the defendant, was tagged in Colorado by a Colorado court. What did he do? He transferred a valuable property to an LLC that was owned by the trust for $10. Clearly a fraudulent conveyance, because at the time that he made the transfer, and he was under a ruling by a Michigan court that said he cannot make any transfers outside of the normal or ordinary course of business until the creditor was paid. Transferring a valuable property for $10 isn't going to work, and no surprise, the Colorado court said it's a fraudulent conveyance, we're unwinding it, and that's going to go back. So planning and proper administration is really an important take-home lesson. So 2 recent cases for the same defendant, and I think given the current environment and the ongoing need for asset protection planning, very important to consider and to think about. I'm not going to go through it. We've done it in other presentations, but we listed here a whole bunch of takeaway lessons from these cases. And really one of the bottom line lessons is, as you would expect, you have to administer the trust properly. As Jonathan said, in the context of adverse party earlier, you want to have the right magic language. So in ADAPT, you want whatever statutory language has to be there, but you also want to administer it properly. And to me, that is the downfall of so many client plans. They don't come back and let their advisors administer the plan correctly. And when you're working as an accountant doing a tax return for a trust like this, hey, client, when's the last time you talked to the lawyer? We haven't had a conversation with the lawyer. Why don't we get the lawyer, the wealth advisor, and you on a call? Let's have an update meeting and make sure you're doing everything right if you want this plan to work. It's hard for the lawyers to reel the clients in, but the other advisors, the wealth advisor and accountant who meet the clients regularly, need to do it. Jonathan, let's change gears completely. And I'm going to just let you comment and then we'll move on to the other topics. But it seems to me that the current environment may have changed the analysis of what we're doing. So in the past, for a long time, almost every trust by default was going to be set up as a grantor trust because we got the tax burn. With a $15 million permanent exemption, and I know permanent's in air quotes, we're not going to go into that, but with a very high exemption, do I really want to have a grantor trust? Might I not want, as we talked earlier, a non-grantor trust for income tax benefit? Do I want that trust to be a completed gift trust, which was often the default answer along with grantor trust status, because you wanted it out of the estate to avoid estate tax and get the growth out of the estate? But now maybe the analysis is different. I may want an asset protection trust that's an incomplete gift because I want it back in the estate for basis step up. Maybe just comment on some of these concepts because I think the conversation may be different.
Well, Marty, again, for a long, long time, the focus was on keeping assets out of the estate. That has really changed now. Maybe you want them in the estate. I don't think you want them to be subject to claims of creditors as a general rule. You could almost always get there by having the trustee make an invasion and hand them to the client, but I don't think you want to do that in most cases. So the question is, what's the best way to proceed? For a domestic asset protection trust, for what are called hybrid domestic asset protection trusts, for special power of appointment trusts, and for spousal limited access trusts. You need to think about all those when you're talking to the client and find out what really fits the client's goals. But keep in mind that you need the flexibility to be able to change, because the one thing I can assure you is the law will change.
I think from a defensive practice perspective, it's important, maybe more important now than previous to OBA, to send a letter to the client saying, we talked about the pros and cons and you should talk about it, even if it's a brief discussion of a completed gift versus an incomplete gift, basis step up versus not being able to, swap powers to bring assets back, not having a swap power if it's a non-grantor trust, grantor versus non-grantor. I think you want to make sure you document in some way that you've had a conversation with clients about all these options, because you don't want someone to come back and say, you never told me I could have gotten my asset protection with an incomplete gift trust by holding a limited power of appointment and gotten a basis step up, or the kids will come and say that. So I think that the analysis and the discussion is different. And I think similarly, the analysis and discussion can be different as to the type of trust that's used. In the past, slats have been kind of like the default plan. But if you give, and Jonathan said this a few minutes ago, the more access you give a beneficiary, the more risk a creditor can get it. And slats had been the common starting point for a lot of these discussions. But I think, Jonathan, and just, give some comments or thoughts on it. We don't have to go through all the techniques because they're described here and we've talked about them plenty of times. But I think for some clients, instead of doing a slat, a hybrid DAPT, or a SPAT, they now feel more comfortable because there's less worry given the high exemption of an estate tax audit that's going to cause a large estate tax. So maybe you want to at least offer the client the opportunity for more access than perhaps you would have suggested when our exemption was going to be cut in half. Thoughts, comments?
Well, Marty, one of the things that I mean, this is critically important, is that, again, the focus typically is, especially for wealthy clients, is getting the assets out of their estate. And Marty, you can tell a story about a firm in New Jersey which assisted in doing, I think it was an installment sale to a grantor trust. And from an estate tax perspective, things worked out great. But when the client died, there was no step up in basis, and I believe the family sued or threatened to sue. So you've got to consider both that, and you need to tell the client that, look, we may be able to save a lot of estate tax, but there's no guarantee you will get this stepped up basis. And the client will then ask, well, how do we do both? And there are ways you can do that, but you need to think about it ahead of time. You need to document that you've mentioned it to the client. And again, if you have the assets go down in value, you're not going to want it included under Section 1014A. You want to have it could just carry over from the trust to the beneficiaries so they pick up the trust's higher basis.
A couple of comments. I think that one of the things that's very important is we all have conversations with clients that we don't document. You just can't possibly document everything you do. But I think to be protective of ourselves, it's worth making an effort to try to at least follow up important conversations with details, some details, to show that you gave the client options and the path chosen was their path of choice. Because otherwise, why did you do this becomes the question. Well, we talked about option A, B, and C, and D. Client was comfortable with option B. That's what we did. So you want to be mindful of trying to do that, which is very hard given all the pressures of practice and clients' reluctance or even annoyance of paying for a follow-up letter or memo. But I think we need to be mindful of the exposure that we face and documenting it. So I think the risk assessment is now different. Clients may view the concern about estate tax less and the concern about access more. I think that kind of sums up what I think is different. Oh, and by the way, and I know this is obvious, we've talked about it before, but if you're doing non-reciprocal slats or non-reciprocal slants, why not try to look at ways to make them more different? If you're certainly doing grantor trusts, because you can't have a DAPT or a hybrid DAPT necessarily, that's going to, you can't make that a non-grantor trust, I don't believe. But you can have different types of trusts for each spouse to further differentiate from the reciprocal trust doctrine. Jonathan, why don't you take a few minutes and talk about flexible beneficiaries that can be built into new trusts or perhaps added by using a limited power to appoint to a successor trust or decanting, and especially how that could be valuable given the changing income tax and estate tax environment.
Well, Marty, everybody, when they think about trust, primarily focuses on estate tax inclusion. But trust can also be your best friend from an income tax perspective. If you have a grantor trust, for example, the grantor is going to pay the tax, and that's going to allow the assets in that trust to grow free of income tax. And tax-free compounding is normally the most powerful force in all of financial planning. So that's something you want to do. In addition, if you don't have a grantor trust or you make it a non-grantor trust, you may have opportunities to reduce taxation by making distributions in various ways. One of those ways, of course, is to distribute distributable net income, DNI. DNI, of course, is just a little bit more complicated than DNA, but you can get through that, and you can get DNI distributed out to a beneficiary so it's includable in his or her or even its return. Because keep in mind that the beneficiary of a trust doesn't have to be a human being. It can be another trust. It could even be a corporation and an S corporation. And there may be advantages for that as well. So you need to keep that in mind, and you need to set up your trust so that you can make those distributions to entities or people that you thought, well, we'll never make a distribution to a corporation. Well, you may want to. Maybe an S corporation, so that the assets remain in trust, a qualified subchapter S trust, and they remain in trust with asset protection, and yet they're going to be immunized from claims of creditors, and yet it's going to be taxed to a human being, which is kind of the best of all qualified situations you can have.
And that's because the S corporation income can flow through to the QIST, and the QIST beneficiary reports the income, but the income doesn't, the income doesn't actually have to be distributed.
The only thing that has to be distributed is fiduciary accounting income. But what you can do is you can have a blocker, so to speak, between the beneficiary and the trust. So for example, you have a trust, you have income, you'd like it taxed to a beneficiary, but that beneficiary maybe is on Medicare. And if you give that beneficiary a lot of assets, they're going to lose their eligibility for that, or they may be under a claim of a creditor. But if you can distribute corpus, and that will shift the DNI over to the beneficiary, who's the beneficiary of the qualified Chapter S trust, but the beneficiary doesn't get his or her hands on it, which means you maintain your asset protection. Very powerful thing to think about. Marty and I wrote an article a couple of years ago about that called Flexible Beneficiary Trust, which I think appeared in the AgTech Journal, and it's really worth your while keeping that in the back of your mind. In fact, you can make an argument that you ought to have provisions in your trust allowing that to happen. You don't have to use it if you don't want to, but it's there if you want to use it, and it can be very powerful.
Jonathan, just while we're on flexible beneficiary trusts, it's not intuitive, certainly for clients and probably not for a lot of advisors, to name a child's spouse as a beneficiary. Why might somebody want to do that?
Well, there are a number of reasons. One is, yes, you do not want to put the child's spouse in there as a beneficiary, especially if there's a marriage breakdown. But you can put in that the spouse is a beneficiary only while married to and living with the child or grandchild. And why would you want to do that? Well, maybe the child or grandchild, number one, is a spendthrift. And I've had circumstances where you could not give money to a beneficiary because they would spend it or they would gamble it away. And I've had that happen a couple of times, and it's a horrible thing for the family. But the family of the child needs the money, so you can't give it to the child. I mean, you can say, well, the trustee could apply it, but that limits access, like just going to get groceries at the grocery store or buying clothes or even buying a car. So you may want the flexibility of having it paid. Now, one of the things you can do is to say, well, you can only make a distribution to my child-in-law or my grandchild-in-law with the consent of my child or grandchild. Now, will the child be making a gift if he or she agrees to that? I don't think so, but even if they are, it's probably going to be covered by the annual exclusion or by the child's own exemptions. So keep that in mind, but you can put in that the child is only a beneficiary and eligible for a distribution if they are married to and living with my descendant as husband and wife, and also only with the consent of that child. And I don't think that's a gift if the child merely consents to it, because it's still up to that trustee. And that's one of the reasons why you want an independent trustee. You want a trustee who will really look at the situation and say, yes, it makes sense to make distributions to my daughter-in-law or my son-in-law. Unfortunately, there are a lot of people who become addicted to things such as drugs. And as a consequence, you need to have flexibility to be able to benefit the family.
So I think that the take-home point is more than ever, it makes sense to consider beneficiaries beyond just descendants. And there's a lot of things that can be done with that. Just very quickly, there's other ways to add access. We've always known about these. You can have a provision to loan money to the settlor. You can have swap powers that may be able to bring income producing assets out. You can have entities like a family business, rental property owned by the trust, and the settlor or other desired family members can actually provide services. They need to be real and earn compensation. In a non-grantor trust, you cannot make a loan. You got to be very careful because a loan, unless it has adequate security and interest, is going to taint it as a grantor trust. It's probably best to never make a loan to the settlor out of a non-grantor trust. So the trust selection also affects the access that will be had to the trust. In terms of moderate wealth clients, so often the kind of planning we're talking about is thought of in the context of people worth 20 million, 50 million, higher. But these concepts can all be applied cost effectively for more moderate wealth clients. And I think, it's almost inappropriate to use the word moderate wealth, because somebody worth $20 million, a couple, is very wealthy in terms of their wealth level, even $10 million. And for many practitioners, those are their clients. They can benefit from this planning. How so? Well, first of all, if you use document generation software, you can very quickly tailor a trust to whether it's non-grantor, grantor, slant, with the spouse subject to an adverse party. All those things can be done very quickly. So you have much more flexibility to cost effectively create a document for the particular client situation. You can start, and my default is I always prefer to name an institution in a trust-friendly DAP jurisdiction. But for more moderate income or moderate wealth clients, you may start off naming Uncle Joe or Aunt Jane as a trustee and give a trust protector the power to change situs governing law and trustees so that in the initial periods, they're incurring less costs. They don't have to pay for counsel in the DAP jurisdiction. They don't have to pay for a trustee fee to an institution. So you can get the cost down significantly, but a lot of the benefits and planning from asset protection to income tax benefits can all be applied at a much lower level of income. Jonathan, I think portability is our last topic, and we'll wrap up with that. From a portability perspective, I'm assuming everyone's familiar with portability. I think one of the issues today is with a $15 million permanent exemption. If a spouse dies and their estate is well under $15 million, why would they even think about portability? But they need to, because we don't know what happens next in Washington. The permanent $15 million exemption is only permanent until it changes. I think to protect us as practitioners, it's important. I would send a physical letter in addition to an email if you can. And I'm not saying that's a standard of practice. I'm just suggesting to a client that doesn't let you file an estate tax return to secure portability. Because boy, if they could have gotten a $15 million exemption on the first death and the exemption in a future administration is reduced to 5 million and they didn't get the portable extra 15 million, they could be very unhappy. So it's really important to address that. There is a recent,
Keep in mind also, Marty, that things are not going to stay at a fixed value. I mean, my mother's survived my father by about 20 years. My grandmother survived her husband for 25 years. And if you use the rule of 72, where you divide the return by the rate of return you're expecting, like if you say, well, I think I can earn 8% a year, well, that means in 9 years it's going to double. So that $5 million of property in 9 years is going to go to 10, and then it's going to go to 20, and then it's going to go to 40. And now you've got something that's very significant. So you want to be sure that you can have the surviving spouse inherit that exemption, because you may want to use it later either for gifts or because of estate tax. I mean, there's a real chance that the estate tax rules will become even tougher as if and when the Republicans don't lose their control of the House and the Senate and the White House. So you want to make sure you do it. And case law recently says if you want to do this, and here's the case, the state of Roland, a very important case. It says you've got to file the return on time. It's got to be a complete return. It can't be just something sloppy, which you might want to do because the client said, look, we're so far under the exemption, it's never going to be a problem. Well, as Marty said, that's the exemption today. It may be different in the future. The United States now with a $15 million plus going to grow with inflation exemption is exceptionally high in countries in the world, and it may go away. So you want to go that extra mile and have the accountant or other return prepare a complete and proper Form 706 and timely file it.
I think one of the practical issues is exactly what Jonathan said. The client is going to be hounding the practitioner, lawyer, accountant who's preparing the return. I don't want to pay a lot. I don't want to pay a lot. The whole estate combined is, $10 million. I don't want to pay a lot. I'm not subject to estate tax. But if we end up with a $5 million exemption and that portable exemption, the dissue, is disallowed because the return wasn't complete or properly filed or timely filed, there's going to be a lawsuit. So don't let a client pressure you to do less of a job than you feel is appropriate. But I think that the key, to just wrap up, the key point on portability is it's going to be off radar for lots of clients because the exemption is so high. But as Jonathan and I have said several times in this program, we don't know what, the next election or elections will bring. And I think it's prudent to be safe. It's a cheap insurance policy to assure that you'll never pay an estate tax again. Jonathan, we've tried to, instead of focusing in great depth on non-grantor trust or planning for the new exemption, because we've done programs on that, this is more of a sort of an overview survey potpourri of all kinds of different things that we're seeing going on with colleagues, practitioners, clients, on non-grantor trusts, on changes in how you approach planning, revisiting, reassessing the trade-off between completed gift, non-completed gift, grantor, non-grantor. It's actually much more complicated to pick a plan that makes sense for a client than maybe it was when the exemption was much lower. It seems like intuitively it should be simpler, but it's often not. So hopefully this has given some practical ideas to all of you of how we're seeing the environment we're in. Jonathan, you want to take the last word?
Marty, you've got it.
I've never seen you shy for words, but okay. Thank you, Jonathan. Thank you, Peak ILS, and thank you all for joining us. And I hope that this was helpful and practical. And certainly feel free to email us with any questions or comments or suggestions. We will read them all and take good care to address them if we can. Thank you, everybody.